Hey there, investors. Ready to dive into the world of finance? Want to hear about a magic number that could change your financial future? It's 11.5%. Yes, you heard that right. That's the average annual return of the S&P 500 over the long haul. Impressive, isn't it? That's right, folks. History shows us that this index has delivered consistent growth over decades. The S&P 500 is like the all-star team of the stock market, featuring the best of the best. It tracks 500 of the largest publicly traded U.S. companies, giving you a broad exposure to the market. It's a benchmark of American business success, representing a diverse range of industries. Think about it, 11.5% year after year. That's not just a number, it's a game changer. That's the power of compound growth. Your investments grow exponentially over time. Your money starts making money, and then those earnings generate even more returns. Then, the earnings make even more money. It's a cycle of growth that keeps on giving. It's like a snowball effect, but instead of snow, it's your wealth growing bigger and bigger with each passing year. But hold your horses, it's not a get-rich-quick scheme. There's more to it than just numbers. Investing takes patience, discipline, and a solid understanding of the market. It's about playing the long game. That's what I'm here to help you with. Together, we'll navigate the complexities of the market and make informed decisions. So, are you ready to embark on this journey towards financial growth and stability? Let's get started. Let's break down this S&P 500 behemoth. We're talking about a market capitalization of $7.1 trillion. That's trillion with a T. This index represents a massive chunk of the U.S. economy. It's the big leagues, folks. The S&P 500 includes companies from all sorts of sectors. We're talking tech giants, healthcare heavyweights, financial institutions, and consumer staples. You name it, the S&P 500 likely has a piece of it. This broad diversification is one of the reasons why the index is so resilient. When one sector might be down, another could be on the rise. It's like a diversified portfolio built right in. Now, within the S&P 500, there's a group of companies called the Magnificent Seven. These are the heavy hitters, the titans of industry. We're talking about Apple, Microsoft, Amazon, Nvidia, Alphabet, Google's parent company, Tesla, and Meta, Facebook's parent company. These 7 companies alone make up a whopping 30% of the entire S&P 500's value. Their influence is undeniable. Think about it. They shape our digital lives, revolutionize industries, and drive innovation at an unprecedented pace. These companies are not just riding the wave of technological advancement, they're creating it. From smartphones to cloud computing, e-commerce to electric vehicles, and social media to artificial intelligence, the Magnificent Seven are at the forefront of it all. Speaking of artificial intelligence, this is where things get really interesting. The Magnificent Seven are pouring billions into AI research and development. They're betting big on this transformative technology, and for good reason. AI has the potential to revolutionize everything from healthcare and transportation to finance and entertainment. Think about self-driving cars, personalized medicine, and virtual assistants that can anticipate your needs. AI is no longer science fiction, it's rapidly becoming a reality. And guess who's leading the charge? You got it, the Magnificent Seven. They're investing heavily in AI because they know it's the future. And by investing in the S&P 500, you get a piece of that future too. Section 5. Diversification. Don't put all your eggs in one basket. Now, before you go all in on the Magnificent Seven, let's talk about diversification. Remember that old saying, don't put all your eggs in one basket? Well, it holds true for investing too. Diversification means spreading your money across different asset classes, industries, and geographical regions. Why is diversification so important? Because it helps to mitigate risk. If one investment performs poorly, others can help to cushion the blow. By diversifying your portfolio, you're essentially creating a safety net for your investments. You're not putting all your hopes and dreams on a single stock or sector. Section 6. The myth of owning 500 stocks. Many investors believe that to be truly diversified, they need to own a vast number of individual stocks. Now, some folks might think that diversification means owning hundreds of different stocks. They imagine that the more stocks they own, the safer their investments will be. But that's not necessarily true. In reality, owning too many stocks can lead to confusion and make it difficult to keep track of your investments. You don't need to buy all 500 stocks in the S&P 500 to achieve diversification. In fact, trying to manage that many stocks can be overwhelming. In fact, owning that many individual stocks can be cumbersome and time-consuming to manage. It can also lead to higher transaction costs and more paperwork. Plus, it might not even provide you with the level of diversification you need. Simply owning a large number of stocks doesn't guarantee that your portfolio is well diversified. Remember, the S&P 500 itself is already diversified across different sectors and industries. This means that by investing in the index, you're spreading your risk across a wide range of companies. So, by investing in the index, you're already getting a good level of diversification. This can simplify your investment strategy and reduce the need to constantly monitor individual stocks. Of course, you can always add other asset classes to your portfolio, such as bonds, real estate, or commodities, to further diversify your holdings. This can help protect your investments from market volatility and provide more stable returns over time. Section 7. Index funds and ETFs, your gateway to diversification. So, how do you actually invest in the S&P 500? Well, you have two main options: index funds and exchange-traded funds, or ETFs. Index funds and ETFs are like baskets of stocks that track a particular index, such as the S&P 500. When you invest in an S&P 500 index fund or ETF, you're essentially buying a tiny piece of all 500 companies in the index. Index funds and ETFs are a great way to achieve instant diversification with a single investment. They're also very cost-effective, as they typically have lower expense ratios than actively managed mutual funds. This means you get to keep more of your returns. Section 8. Buying the dip, turning fear into opportunity. Now, let's talk about one of my favorite investing strategies: buying the dip. This strategy is all about taking advantage of market downturns to purchase stocks or index funds at lower prices. This is where you buy stocks or index funds when the market experiences a downturn. Essentially, you're looking for those moments when the market is in a temporary decline. It might seem counterintuitive to buy when everyone else is selling, but that's where the real opportunities lie. When fear grips the market, prices drop, and that's your chance to step in. Think about it this way: when the market falls, prices of great companies get marked down, like a sale at your favorite store. Just as you would jump at the chance to buy your favorite items at a discount, you should consider doing the same with stocks. This is your chance to buy quality assets at a discount. By purchasing stocks during a dip, you're essentially getting more value for your money. Of course, buying the dip requires nerves of steel. It's not easy to go against the crowd and invest when others are panicking. You need to be able to stomach the volatility and trust that the market will eventually recover. This means having a long-term perspective and not getting swayed by short-term fluctuations. But if you're patient and disciplined, buying the dip can be a very rewarding strategy. Over time, markets have shown a tendency to recover and grow, rewarding those who had the courage to invest during downturns. So, the next time the market dips, remember that it could be your golden opportunity. Section 9. The importance of long-term perspective. Remember, investing is a marathon, not a sprint. Don't get caught up in the day-to-day fluctuations of the market. Instead, focus on the long-term growth potential of your investments. The S&P 500 has a proven track record of delivering solid returns over time. Stay focused on your financial goals and don't panic sell when the market takes a tumble. Remember, every market downturn in history has eventually been followed by a recovery. By staying the course and remaining invested, you give your investments the opportunity to compound over time and reach their full potential. Section 10. Navigating market volatility. Now, I know what you're thinking. Jim, you're making this sound easy. But the market can be a scary place. You're right, the market can be volatile, and there will be times when your investments lose value. That's part of the game. But here's the thing, volatility is normal. It's what makes the market go up over the long term. If you can't stomach some volatility, then you shouldn't be investing in the stock market. Instead, focus on building a well-diversified portfolio that aligns with your risk tolerance and financial goals. Section 11. Conclusion, your journey to financial freedom. So there you have it, folks. The S&P 500 is a powerful engine for wealth creation. By understanding its history, its key players, and the power of diversification, you can harness its potential to achieve your financial goals. Remember, investing is a journey, not a destination. There will be bumps along the road, but by staying informed, staying disciplined, and staying focused on the long term, you can achieve financial freedom. Now go out there and make some money.